Good day to you guys. So in this video, I want to talk about fair value gaps and the market. So guys, most of you doesn't have an idea about fair value gaps. So basically, these fair value gaps is something we can identify using three candles. So we call this three candle formation pattern. So guys, this is a logic, or as you guys can call this is a theory, and I want to tell you that this value gaps contains a story, so keep that in your mind. And also I can explain this value gap something like this. Okay guys, a value gap is a place where there is a gap, and which means the price isn't balanced. So keep that in your mind guys, the price isn't balanced. So the logic behind this market is most of the time the price should get balanced and then move. So that is what we call, we should have a balance in liquidity and a balance in order flow. So that concept applies to both short term and long term trading. So keep that in your mind guys. So when it comes to ICT trading, fair value gaps does a major role. So in here guys, you guys can see I have drawn a fair value gap over here. So imagine like both uh, only sell side has offered over here, so the price is moving downwards, and there's a gap over here. So a wick hasn't been traded over here, that means there is a gap. So we call this fair value gap. So that's how you identify fair value gaps. So I will show you guys some sort of examples in the chart. So I just want to give you guys the idea, or is the logic behind this. So basically, think that market moves something like this, and it gives a manipulation move to purge out buy side liquidity. So the buy side liquidity may contain in fair value gaps also. So some people tell that fair value gaps is a period, and that is true guys. So the reason that I call this a buy side liquidity is sometimes market takes liquidity inside fair value gaps. That's what we call internal range liquidity to fair value gaps and order blocks. So keep that in your mind guys, fair value gaps and order blocks contains liquidity. So most of the time those things act as a magnet in this market. So after taking the buy side liquidity, price will make a market structure shift and takes out the swing low, and by taking this fair value gap over here, okay, like just filling up this fair value gap, and just imagine that there is another fair value gap over here. Okay guys, there's another fair value gap over here that, like, after a market structure shift, the price has gave a aggressive move down, and there's a fair value gap over here, and this order block will be acting as a striker, and then comes back into this fair value gap, and then goes back. So that's how it goes guys. So this fair value gap is also a liquidity, and we call this internal range liquidity. So if you guys doesn't know about internal and external range liquidity, that means liquidity runs, you should have an idea about that. So this is a simple theory guys. So you guys can have an idea, if you guys know about power of three and liquidity concepts, you guys can predict the market with the help of fair value gaps. So in this case, like, imagine we got an accumulation phase over here and a manipulation leg to a fair value gap over here, and by respecting that fair value gap, like rejecting from a body and a market structure shift from here, so, and respecting to the order flow, we can catch a trade. So that's how it goes guys. So in here you guys can see we have a fair value gap over here, and I consider fair value gaps as liquidity guys. So a market has to come there and take the orders to fill the gap. So that means the institutions will tend to move the market back into fair value gaps and take those unfilled orders and comes back down. So order flow is a key component when you guys are predicting the market using fair value gaps. So I told you guys that before. If you guys doesn't have any kind of idea about order flow, please guys, like, for God's sake, just have an idea about that thing. So I can give you guys a simplified version if you guys want to. So make sure to hit me up in the comment section down below. And yeah, so I just want to explain this chart over here also. So guys, this market has two types of traders. Okay guys, two types of traders. So people call SMC, or as the smart money concepts, the people who are trading smart money concepts thinks that there are institutions, like those buggers are institutions. But guys, trust me, the things that you think like you're trading according to the smart money's concepts or as institutional concepts, like trust me guys, those concepts are 100% man-made things, or as those concepts are 100% retail, because guys, these institutions won't leak their information or else won't give out to the general public how those buggers are trading. So keep that in your mind. So, and there are retail traders as well. So people think that trading support and resistance can't make a profitable trade, or else you guys cannot make money using trade by trading support and resistance. That is the biggest lie I have ever heard. Because guys, most of the time I have seen hundreds or thousands of traders who are trading support and resistance and making shit ton of money. So keep that in your mind, guys. Uh, I'm saying that if you guys want to succeed in this market, you have to have a top 1% mentality or a top 1% psychology in this industry. So guys, the market has a market fuel. So for the market fuel, they use liquidity. So that's what I told you guys, buy side liquidity and sell side liquidity. So there should be a balance over here. So that's what I explained over here. So after that, we call purging this liquidity. So this is a different story, guys, but keep that in your mind. So after that, market strikes. That means market gives you guys a distribution move. After taking buy side liquidity, market takes the chart back into sell side, like by a distribution move. So after that, you guys can make money. So this is a simple concept, guys. So this is something that is simple, but the thing is, you guys cannot identify uh, according to time the price will take buy side or sell side. So you have to have an idea about time and price concepts as well. And yeah, so but for this, in this video I want to talk about fair value gaps and market predictions. So I will provide you guys a chart explanation. Okay guys, so in here I have taken the XAUSD chart or as the gold chart. So you guys can clearly see, or as if you guys doesn't know about fair value gaps, how do you guys identify those gaps? So basically, fair value gaps are a formation of three candles. So that means there should be a gap. So simply something like this. So you guys can see we have a gap like this over here, and the gap is getting filled right now, and we can consider this as an external range liquidity, this low, and like this one, external range liquidity over here, and then this area as internal range liquid or as our fair value gap. So I told you guys before that these fair value gaps act as a liquidity zone. So if you guys doesn't know about the bias for today, so if the price breaks this fair value gap, or else it does not respect to this fair value gap, that means the price might go down. Well, I mean, price might go up, like making a market structure shift, and it might go up. So if you guys don't know about how to identify the respect move, so that means if a candle closes, the candle body should close above this fair value gap. So after that, we consider this as a invalidation of fair value gap, and then we can just target this swing low over here, and yeah, something like this. So the market moves according to cycles, guys. So make sure to keep that in your mind, so you guys know that we can take this trade. If it gives us a move something like this, we can look for sales. So but most of the time market won't try to sell, because you guys should have idea that about psychological zones. So I just gave you guys an idea about the price action, but don't take a trade considering this thing, because most of the time price might invalidate this trade, like invalidate this order block, I mean fair value gap, and then just goes up. So yeah, and I just want to tell you guys, let's go to 4 hour time frame and let's see. So we are on the higher time frame, guys, over here. So you guys can see that price has broken these highs up over here, and then price moves back into this fair value gap over here. Okay, so you can consider this as a fair value gap, since you guys can see there's no wicks traded in that zone. Okay, for the three candle formation, so that fair value gap has been filled up, so then the price has to go up. And yeah, so you guys can see there's a fair value gap over here as well. So the price might come up, guys. Okay, the price might come down also, because there's a fair value gap over here, but this is gold, guys. So most of the time price should have some sort of a fundamental reason, some sort of a strict fundamental reason to move that much of range. So over here, to this zone, okay, this fair value gap, it is something like 600 pips. Okay, guys, so to move 600 pips should have some sort of a political news, or is some sort of a fundamental news to move that sort of a high, that sort of a range. So but the thing is, you guys can actually take trades using that thing. So most of the time, go to 1 hour time frame, like, and just look for fair value gaps. So in this case, I can see this fair value gap over here, and I can see this fair value gap over here as well. Okay, guys, so forgot that this is gold. Okay, guys, just something like that. Okay, and I can see the market is trending to the downside, like breaking these structures over here. You guys can see, and I'm looking for sales. So the price might sell off from this area, or is I don't know, like from the consequent encroachment of this fair value gap. So then I can look for sales, but I'm looking for some sort of a market structure shift in the intermediate time frame over here to take trades. So that means, I just want to tell you guys, don't ever come to a conclusion looking at the high time frame. Just look for confirmations in the intermediate time frames, and then shift to small time frames. So only in that case you guys can make money in this market, and make sure to stick to your plan and be disciplined. So I can show you guys another trade that I took using this value gap theory, and yeah, so it goes. So here, this trade that I took over here, I took this using fair value gaps, and I identified my bias using fair value gaps. So the main intention that I want to share in this video, or as the main lesson that I want to share in this video, is about fair value gaps, or as you guys can call it, FVGs, and how do you guys use those things, and how do you guys identify the bias using fair value gaps. So guys, basically you guys can predict this market using fair value gaps and liquidity. Both work in the same manner, in the same method. So you guys can use some sort of a confluence, or something like power of three and order flow, something like that. But mainly, you guys can use these fair value gaps and just execute your trade. So in here, I took this trade in USD JPY. It's something close to 65 pips actually. And so basically, guys, I anticipated this trade to cover up the consequent encroachment of this fair value gap over here. So if you guys listen about consequent encroachment is simply the 50%. So you guys can see the 50% of the fair value gap has been successfully filled out, and also this mitigation block, or as this market structure shift, has been reacted. So that's the thing that I told you guys. The consequent encroachment is something that is more powerful than you think, guys. So if a PDRA is respecting its 50% level, that means the PDRA is valid, and it can give you guys a good result. So you guys can enter up a sell trade targeting this fair value gap and trading the change instead of derivative trade over here, trading this order block over here. You guys can capture this trade, something like this, by aligning time and price concepts also. So in this case, it's something of London session. So that means you guys can take a trade something like this. So actually I didn't place that trade, but I placed this one over here. So the striker to this trade is this small fair value gap in the 50-minute time frame. If I go to something like 5 minute, or else yeah, yeah, like I mean 1 hour, you guys can see that I have an order block over here, 1 hour order block. It's somewhat, I call it a striker, and that order block respected so fucking good, guys. So I can use tap day concept as well over here, 7 p.m. and 7 a.m. So tap day is also there. So this order block works perfectly fine. And this order block is built up by respecting this market structure shift over here. So after taking the orders over here, but the thing is I took this trade during this area. That means like most of the time it was a fair value gap, like in the 50-minute time frame. You guys can see I have a fair value gap and I kept a pending order over here and it's shot up. So after that the price moves back into this fair value gap. So the basic theory that I'm going to use is that I want to show you guys is like when it comes to the 4 hour time frame, you guys can see a fair value gap over here and an order block over here. And when it comes to fair value gaps, this fair value gap has to be filled and then go down. So here this is a downtrend over here, and this high hasn't been break, so that means still the trend is downside. And I know this is a counter trade, but when it comes to short term perspective, it is to the trend, so it doesn't matter. And I targeted this fair value gap over here, so you guys can have an idea like that. So by trading fair value gaps, you guys can take quick ins and outs, but the thing is you might come confused. Like sometimes people say that making fair value gaps like this, they don't get filled just after taking an external or just after taking a low. So over here this order block has been violated, and I mean that this swing low, sorry, swing low has been violated. So then it went back to take this internal range liquidity or as this fair value gap over here. So that's how I read this market over here. And the thing is, like if I go to 50-minute time frame, I can see that the price is still on a downtrend, and I can take a trade from here as well. So that is how I took my trade. So guys, I just want to give you guys a plus tip. If you guys are trading by looking at time and price, so in this USD JPY, I don't know about the time and price concepts as well, because sometimes the time and price concepts works, but most of the time I didn't got that much of knowledge about the time and price things to apply on USD JPY. But most of the time USD AUD USD gold and NAS 100, those things, those three pairs, I know the time and price concept. So guys, basically time and price things differ from chart to chart or as pattern pair to pair. So in this case I didn't use time and price, I just simply use raw price action over here, fair value gaps, internal, external, that's all. So took this trade, and I just want to tell you guys this fair value gaps over here is something we call IFC, or as institutional funding candle. So those candles should be filled up. So if you guys doesn't know about IFCs, that means IFCs are something like some sort of funding financial institutes. Those buggers are funding these pairs to make a move. So like imagine cleaning out these liquidity by just giving a pressure move up like this. So we call this a IFC. So after taking the 50% of this IFC, most of the time price reacts to the downside. So after that, it's all good. So that's all, guys. So this is how you take trades using fair value gaps.